Hey, party people. Welcome to this week's Money News in Human Words. Look, there's a bit going on at the moment, and this week it's changing tack just a little bit. And there's really only one. Well, there's a bunch of stories that I've been looking at, but they all sort of roll into one, which I'm keen to unpack on what it actually means in the current environment. Then I'm going to share a story of someone that we've been working with recently that was working through this issue, which was holding them back and what they did to sort of get around it. The big story, or the multiple stories that I've been looking at this week, is around the what's going on in the economy, potential for recession, and there's a lot of headlines out there at the moment. RBA last week came out with another interest rate rise. That's created the fastest pace in interest rate tightening in the last decade, highest mortgage interest rates in the last decade as well. And I think for a lot of people that we talk to, not used to seeing interest rates this high, because all through the wealth building over the last decade, we've been seeing these rates super low, and that's been kicking the can on for markets, both the share market and the property market. And a lot of people have been fortunate to be able to take advantage of that positioning. But with this interest rate rising and what's going on in the economy, the inflation crisis, the Ukraine war, all of these things are sort of coming together to create a bit of a difficulty and a number of challenges. We're seeing, particularly in the US, there's a big slowdown that's happening over there. New properties being built, there's what they call the property starts is way down. And that is a leading indicator of a downturn in their economy. Their household savings rates are significantly lower. We're also seeing that in Australia. So we saw the stats just came in on household savings rates in Australia, which declined to 6.9%. That's down from 8.7% in the last quarter, which means that people are eating into their savings rate. No surprises with the rates being higher, cost of living being higher, but it means that people have got less of a buffer. Worth calling out that Aussies did manage to sock away $260 billion through the COVID pandemic. So a lot of people have got a bit of a war chest to fall back on. But the fact that the rates are in decline does create a little bit of extra economic risk. Now, at the same time, we're seeing commercial property values are declining. We're also seeing a significant write down in a lot of unlisted asset values, like infrastructure assets, toll roads, skyscrapers, these sorts of things. And it's no surprise, because these are multi-billion-dollar assets. And when interest rates are higher, it means that people can get more money on cash. It also means that people that are borrowing to buy those investments, which is what they typically do, are paying higher rates. So they're not getting as much of a yield for them. Now, at the same time, there is some good news out there, where in Australia, we saw the economic growth stats just came in, and last quarter was up 0.6%, which brings the growth for the year at like 5%, which is a really high growth rate, particularly coming out of COVID. To see that strong growth there is good. And at the same time, we've seen unemployment levels really low and wages growing, which is a code that we haven't managed to crack in the recent past. But we're seeing some strong acceleration there, which is good for a lot of people. But here's the thing with the risks that we're facing. It's seeming likely that the US is going to go into recession. They sort of did meet the technical definition of a recession, and then they sort of changed the definition a little bit. Australia, we're a little bit insulated in that we do have good resources which keep us protected a little bit, or keep us buffered a little bit, maybe not protected, but buffered from this disruption to the economy. And it means that when there's declines, we see governments around the world, they spend up on resources, and we benefit from that. So fingers crossed that we can ride out the downturn. But either way, whether we do or whether we don't, it's likely that investing conditions are going to be soft in the next little while. And it sort of reminds me somewhat of what we saw in the COVID pandemic, where a lot of people, like the share market massively declined, the property market was declined, and people could see that there was potentially some opportunity there. They could definitely see that values had gone down significantly from their highs, and that we know that good assets in that condition, good assets are good assets and good investments that will make money over time. But what happens is, and this is the big call out that I wanted to sort of tie this story in for what it actually means for investors. The thing is that people are really fearful in that instance. And we spoke to a ton of people through COVID that knew that there was an opportunity out there, but when it's seeming like the world is going to end and there's all this negative talk out there, people don't want to pull the trigger. But when you have a clear plan around your money, and when you know what you're doing with your investing, you know how much you can invest, you know that all of your lifestyle things are provided for, it means that you can pull the trigger on investing and invest with confidence. And as as Warren Buffett says, it's like when it's raining, I'm probably mixing up the words exactly, but when it's raining, you want to be carrying a bathtub, not a thimble. So you want to be taking full advantage when those conditions are down. And it really is the downturns that make millionaires. But if you don't have a rock solid plan around your money where you know what you can invest, how much, and know that you can do it, knowing that you've got your emergencies protected for, that you're not going to be having forced to sell investments at the wrong time if you get made redundant from your job or your business isn't working as well as it was a month ago or whatever, it's really, really scary to invest. But investing as much as you comfortably can while still protecting your risk and still providing for the lifestyle you want is the thing that will make the biggest difference to how quickly you get ahead. So it's a really important code to get right. My strong piece of encouragement, and I get that at this time of year, a lot of people are taking their foot off the pedal and not wanting to do stuff because the Christmas break is here and blah, blah, blah. But not doing that means that you're not going to be in a confident position to take action. And to put it in a different way, if you know what your plan is and what you've got to work with, it means that you can pull the trigger, invest as much as you can comfortably do, and that means you're going to build your wealth as much as you comfortably can. So I'd encourage you to figure out what is actually important to you, take the time to map out what you're doing, or get some help to do that, and the benefits will definitely pay for itself, because the people that we saw that invested strongly when the downturn was happening with COVID, they made boatloads of money. And the ones that didn't, they still made money, but they didn't take full advantage and regretted not acting sooner. So if this thing plays out and it means that conditions are bad, then you don't want to be regretting that. And if they don't play out that way and conditions are good, then you will also have missed the boat if you're not putting things in place. So strongly encourage you, take the time, do that, and your future self will thank you for it. I wanted to also just share a story from a client of ours that was working through this interesting issue over the last little bit, that we found out afterwards was actually holding back their wealth building to the tune of $50,000 a year. So getting into the numbers, this as a young guy, he had an income of $160,000. His asset position was $420K. Net asset position was $420K, but he actually had total assets. He had 2 investment properties, which had a combined value of $1.6 million, which he owned 50% of. One he half owned with his brother, another he half owned with his mum. They were worth about $800,000 each. He was saving pretty strongly at $30,000 a year, which he was directing into shares and ETFs and cash savings. He was doing that because his borrowing ability was capped. Now, what happens when you borrow to buy properties jointly with another person? The banks look at you like you owe the entire amount of the mortgage, even though the mortgage is only half yours. Then the banks don't really care too much about that, because if something happens with the property, and then the banks need to get their loan back, they can go after the co-borrower for that. So anyway, basically the banks wouldn't lend him any more money, but he was in this position where he had a contract job where he knew that his income was going to be higher for the next few years. He was getting smashed with tax bills, and he wanted to take advantage of his position. He wanted to do that in a way, though, where he wasn't taking on tons of risk. So what he ended up doing went right through the process, sort of end to end, and he ended up deciding to sell one of the properties on the market. The one that he owned with his mum, they sold on the market, cashed out. The one that he owned with his brother, he sold his half to his brother. And then he went out and purchased 2 other investment properties with the same total combined value, $1.6 million. But he owned 100% of these properties now because he wasn't co-borrowing with somebody else. So what happened was he ended up getting an extra $800,000 worth of property that was working for him. Now, when you look at the 150-year growth rate on property in Australia, that's 6.3%. So $800,000 of upside means that he would be getting basically growth upside of $50,000 per annum. Um, he As a result, he ended up with the same sort of assets where he was taking advantage of the income that he had, um, and he was getting his assets growing. So, like I said, he thought he was doing the right thing, and I think with joint property, you can often think that it's allowing you to get in the property market. You know, you're doing it with sibling. There's probably not a lot of issues there. But it can seriously hold you back because of that borrowing capacity thing in particular. So sometimes unwinding them, looking beyond the numbers to what would actually be possible, and you can sort of fast track your success. To me, I think what that really does is it allows you to take full advantage of your situation. So this guy thought he was doing the right things, but on diving a little bit deeper, recognized that there was a bit of untapped potential there. It's an issue that's worth you being aware of around borrowing, but also a broader lesson in that you want to just make sure that you're not missing a trick that could be getting you better results. Guys, that's it from me for this week. I'll catch you on the next one.